Hello everyone. We'll be starting in a few minutes. Till then, please be quiet. Thank you.
Good evening, everyone. I welcome you all to this enlightening session where we will go through all the topic related to financial independence and address your queries and concerns for the same. I would like to take a moment to welcome our speaker, Mr. Akshay NAGPAL, a chartered accountant and currently working as financial associate. He has exposure to majorly all areas of finance. Sir, we are honored to have you with us. Attendees are requested to maintain decorum and discipline throughout the session, and if anyone has a query, he or she can write in the chat box. All queries will be addressed at the end of the session. We are pleased to have you all on board.
Thanks, Yuvika. Am I audible? Hello, am I audible?
Yes, sir.
Yeah, so hi everyone, good evening. I'm Akshay Nagpal and I'm a chartered accountant by profession, as Yuvika told everyone. And I am currently working as a finance associate in an MNC, US based MNC, as a treasury accountant. So that's that. And I'm a commerce graduate as well. And that's all. So I'll be starting with the presentation. Do let me know if you can see the screen that I'm showing. Is it visible? Can anybody confirm?
Yes, sir, it's visible.
Yeah, great. So as you already know, we are going to simply tell you about how to be financially independent. This is basically a presentation that is going to basically clear all your concepts, and we are going to cover everything in between. And that's the disclaimer that you should know before I go further. This is only for the education purpose, and it is not to be construed as an investment advice. Since the reason because I am saying this, that you need to have a license in order to give the investment advice by SEBI. All right, so this is for education purpose only, and there is not going to be any brand endorsement of any sort. And as I'm going to take for the few names of applications that you can use in order to gain understanding and in order to gain your perspective, increase your perspective. All right, and you can use the Excel and the presentation for fair use only, and you can have that from me after the presentation gets over. You can ask me over the WhatsApp and any other sort. All right, so that's the thing, and these are the topics that we are going to cover. First being the financial independence, and our major topic that we are going to cover will be this financial independence. How can you be financially independent? The concept of fire. This is literally new in India. This is prevalent in US a lot, but it is very much new in India. The concept of fire. Fire means financially independent, retire early. So I'm going to make you understand the concept of fire using an Excel sheet. So that's that. And I'm going to tell you about the investment perspectives, that where you can start investing from the very basics. And we are going to scratch the surface only, since this is the vast topic and we have limited time today. So I'll be telling you the options that where you can invest, and I'll be telling you the concept of inflation, which is very much important in order to gain the understanding of investing, and also the compounding, and how compounding is very essential in order to break the inflation. All right, so we'll do that by an Excel as well. And my favorite topic would be the mutual funds and SIPs. This is the game changer. All right, so you should have a clear understanding how you can start investing in mutual funds, how you can you make use of SIPs in order to basically defy the market fluctuations. All right, and what you can do as a student of first year to fourth year. I'm not sure so how many participants are there, and in which year you are. So I'll be touching upon that area as well, and the miscellaneous topics will be covered as well. That is credit card versus debit card, and few tax compliances that you need to know in order to in after that after some time that you are going to get a job. All right, so you need to have a clear understanding of what tax compliances are as on today, and the changes and the amendments that are happening year by year, and you have to have clear understanding of that. All right, and last but not the least, the Money Heist season 1 and season 2, the impact of that in the Indian scenario. How many of you are the fans of Money Heist, and how many of you have already binge watched the Money Heist season 5 yesterday? Can anybody tell? You can unmute yourself. Nobody? Am I audible?
Yes, sir.
So no one? No takers? Huh? All right. I guess it's a one-way conversation only. So that's okay. So starting with the Money Heist season 1 and season 2, if you have watched that, in that the professor tells their gang to heist the bank and print a lot of money. So I'm asking you, that is printing unlimited money a good option for RBI, like to basically eliminate the poverty, and how can it impact the Indian economy? So the answer to that will be given at the end of the slides, so you can stay tuned if you want to. I will go to next slide. All right, so let's talk about financial independence. As per this definition, which is stolen from the Wikipedia or Investopedia, it simply says that the status of having enough money to pay one's living expense for the rest of one's life without having to be employed or dependent on others. Income earned without having to work a job is commonly referred to as a passive income. So in simple terms, in my perspective, financial independence has two stages. All right, the first stage being the, you can say, on the job, and the second stage being after the job, that is after the retirement. All right, the first stage, I suppose every one of you are going to cross the first stage, that is, you all will have a financial, you all will have the income of some sort in coming future, sooner or later. So you will be able to basically expend and be financially independent during the job, I'm sure. But the stage 2 is the key to your financial independence. The stage 2 means after the employment or after the job, that is after the retirement, basically how you are going to basically be financially independent, how you are not being reliable on anyone for your expenses, for day-to-day expenses, and for your luxury hotels and all. So that's the stage 2 I'm talking about, and we are going to focus on stage 2 most during this session. All right, because stage 1 is going to happen for you, I'm very much sure. All right, so what you can do, that is, as a student, you can start building your career. All right, this is you are already in the stage. All right, you are already engineers and going to be engineers. So the career path is almost set. Most of you are set already, but a few of you might be having some troubles, for like might be having some second options in your mind. So that's a different thing. And the skill development is the second thing that you should start doing in order to gain your, you can say, the freelancing thing and everything. All right, so skill development should be your major focus. And the third thing being having the passive income. All right, the passive income should be occurring after the active income. All right, active income means having a full-time job or a business you have. All right, so you are having a active income, only then only after that you can have the passive income. All right, so this is the thing. And this slide, you already must know that why you should be financially independent: to have the financial freedom, ability to pursue your passion, better lifestyle, retirement as per your convenience, life of choice. I don't think so. This is self-explanatory, and I don't think I need to explain this to all of you, to any of you. All right, so as I already mentioned, that investing in your career should be the first priority, since this is going to be your key stage, and this is going to be your basically active income source. All right, the investment in your career. And after that, as soon as you start having the income, you should have a safety net. Safety net means you should have the emergency funds available. This is your first step, to have the health insurance, to have the life insurance, to have the other motor vehicle insurance and all. That's the different thing. To repairs and all. So health insurance and life insurance thing are the two major things that you should focus on as soon as you start earning, as soon as you start having your active income. All right, the passive income comes after this emergency fund. All right. So as soon as I'm talking about the passive income, passive income means basically buying the assets that can generate income. For example, having your investments in SIPs, or having your investments in a real estate. You can have the rent from that. All right, and having your income in investing your income in equity shares, in FDs. You can have the interest income. So that's the passive income, and that's the fourth thing that I'm talking about: buying the assets that generate income for you, which is also known as passive income. So first and foremost, invest in your career. That is the active income source. Second, build safety nets. Third, buying the assets that generate income. That is passive income. And fourth, the major part, the major important thing is planning and budgeting. Planning and budgeting is essential, since many of you ignore this thing. You have the income, you have the money, but you don't plan it well. You don't plan it well in advance, and you end up falling down in your knees on your knees. All right, so planning and budgeting is essential, and you can use the applications for that as well, or I personally use the Excel sheet. If you want, you can have that after this presentation. All right, and be aware of your financial position. Financial position basically means to be aware of the liabilities and the assets that you have. Liabilities means the obligations to pay money to someone, or to lend to someone, that you have already received the money. For example, you have taken a loan, then that's the liability for you. You have to pay back to the bank, and that is the thing that you should be aware of, that in coming months you will have to pay the money to the bank, and you need to have the money. You need to have the safety nets for that as well. All right, and knowing about the assets, that could be a thing. All right, so let's get to the next slide. What you can start doing as a student now. Right now, as you are in an early stage of your career, it's basically, you can start with your freelancing and internships. I'm very much sure that you all must be doing, or like planning to do at least. And the internships and freelancing is the first step in your as a student that you should do. And you can use the application's name, Freelance and Upwork. Upwork is a great application. I have heard about it yesterday only on a YouTube video that I was searching. And the Upwork application is all about freelancing and all, so you can check that out. All right, and the second thing is about the having the skill development for earning the passive income. For example, you as an engineer, or computer engineer, I guess, who make the applications, or who uses the language in order to make an application. So you need to have those skills in order to generate the passive income, or in order to even start your freelancing at all. So that can be a thing. And transcribing can be a thing. Video editing can be a skill. So you can start focusing on that as well. Plus, you can as far as your investment journey goes, you can start using a virtual money investment apps. Virtual money means you will get the money, virtual money. That is, you will be having the virtual money, and you can learn by investing, not through your money, but the virtual money that you will be given by the application. This is a great learning opportunity, and the great application to use to apply that is MoneyBhai. That is Money Control's partner. Money Control, I'm sure you must have known. Its partner is MoneyBhai, and that's the application that you can use in order to start your journey towards investment. That is by learning. All right, at least till you are not earning, you can start learning. All right, and you should have an account on LinkedIn, and because you can generate income from that as well. You can have the business opportunities from that as well, and you should have an account, and you should have a website as well. Website, I am personally having a website. I'm personally in it's a work in progress basically. So that should be a thing in order to make your business work. All right, in order to gain the passive income, or in order to have your portfolio. All right, so you should have a website as well, and have an expertise in your area of interest. For example, maybe most of you must be doing mechanical engineering or software engineering or any of the sort. So you should have an expertise in your area of interest. If you have the interest in that area, then you should have the expertise in order to gain the market, in order to gain the clients in future. All right, or in order to have the companies follow you. All right, so that's that. And you should start reading economic news and finance news, and this can correspond to your learning application, that is virtual money investment apps. You can start using the this ET Money app ho gaya, and there are other finance apps that you can use in order to gain the understanding of the market and in order to earn money as a passive income. All right, so I have covered up till now the three things. First, what is financial independence, why financial independence, and how you can start your journey as to be a financially independent person. All right, and what you should do as a student now. So now let's start with this investment journey that you can start. All right, so these are the options that you have in order to these are the options that you have that you can use, that you can invest in after you have a certain amount of money. All right, so I am sure you must have known about the fixed deposits thing. Fixed deposits is basically low risk, since it's a bank approved RBI approved, so the low risk, but the returns are low as well. And fixed deposits are the worst thing that can happen to Indian society right now. All right, so I'll tell you why. Because of the inflation, but we'll be studying that through an Excel sheet as well. So that's that. And the second option that you can have is gold or the sovereign gold bonds. Sovereign gold bonds is basically the alternative to gold. Gold has a certain limitation towards the risk, that is high storage risk. It has the theft. Basically, the theft issue can be there if you have the physical gold. So in order to mitigate that factor, you can invest in sovereign gold bonds, and this is there is a tax exemption as well in sovereign gold bonds. If you hold for the 8 years or 5 years, the sovereign gold bonds, the redemption amount won't have any tax impact. You will be having the money without any payment of taxes. All right, so and the returns are more than FD, so you can go for gold, I would say. And the history says that the gold has given more returns than any other securities except equity. All right, and the third part is PPF and NPS. PPF means Public Provident Fund, and NPS means National Pension Scheme. So PPF is a great opportunity, investment opportunity for everyone. PPF is basically a government scheme. So every year the percentage is prescribed by the government, that this percentage will be given to the amount of investment that you have made in the PPF, and you can redeem that amount only after a certain period of time, that is only during retirement and all. So that's the limitation of this, but you can have the advantage of low risk. All right, and the return is almost 7 to 8 or 9% in this PPF, depending on year to year, and the government prescribes the rate. So that's the thing. Now talking about the fixed income securities. Fixed income securities basically means that you will be having a fixed percentage of income if you invest a certain amount of money in those things. Fixed income securities, example can be debentures, example can be bonds. A company can issue debentures, or a government can issue the bonds, the 10-year bonds or the 5-year bonds, and prescribe the particular percentage of interest that they are going to pay you. So that's the great opportunity you can utilize after you have some money. So the fixed income securities is the great opportunity, and the returns are more than FD. Since the risk is a little bit higher in case of that corporate bonds, not for the government bonds. The corporate bonds, since if the corporate is liquidated or something bad happened to the company, then that can impact your investments. So that you'll have to see, and you can see that using the ratings. Ratings are given by some rating agencies like CRISIL, and there are other as well, and these basically rate the investment securities on the basis of AAA to CCC. If the government security is if the government security has a rating of AAA, then that means the risk is really low, and the company and the probability of company being liquidated is very low. So you have the low risk, and the return can be higher depending upon the percentage to percentage, depending on the securities to securities. And the higher risk securities, for example, if a security has a rating of CCC or CC or even BB, there are very much there are very much variety of so many varieties of ratings that you can see. And for that, you will have to basically you will be having a return more than FD. All right, and if the ratings are low, the returns can be higher. All right, but you will have to take the risk, and you will have to research well in order to start investing in those fixed income securities. The next one is equity instruments, equity investments. I'm sure you must be learning that for a while now, since the Nifty has reached 17,000. That is all-time high right now. And you must have known about the Reliance shares. You must have known about the Tata Motors share, Tata Steel shares. So this is investment opportunity, and the risk here is higher, since the equity investments basically means that you are basically having the ownership of the company. All right, for example, if you are purchasing 10 shares of a company, then you are basically having the ownership in that company for those 10 shares, and you can participate in the general meeting of the in the general meeting of the company's board and all. So that's the advantage, and that's a disadvantage. Disadvantage is that the risk is higher, risk is on the higher side, and you won't be guaranteed any income of any sort if the company gets liquidated. In the case of fixed income securities, the percentage of investment was fixed, and you will be given the percentage of amount, but the equity investments don't have a percentage fixed, and you will be given dividends, you will be given capital gains. Capital gains means if you have invested 100 rupees in a company, and that share has been increased to 150, that the 50 rupees that you have gained is the capital gain. All right, so those equity investments have the higher return, but the higher risk is there, since you will be given the least opportunity, because you are basically the owner of the company, and owners have the highest risk, as you must have known if you have any relative who is doing business. So the owner has the biggest risk in the equity investments, and you are going to be the owner if you invest in equity shares. All right, the next is mutual funds. Mutual funds, I would like to take some mutual funds I have already included in the further slides, so I'll be taking up there. And the next is cryptocurrency. Cryptocurrency is, as you must know, this is the newest way of investing, and the returns have been higher than ever. All right, so but due to the volatility means the fluctuations in the prices of the crypto. So you need to be very very skeptic about these cryptocurrencies, and you should understand the crypto first before investing. All right, so cryptocurrencies are volatile, and every tweet of Elon Musk can change the price of the cryptocurrencies. So beware of that. And the risk is higher, returns are higher. Many people have become the millionaire because of this cryptocurrency, and many people have lost their hard-earned money because of this cryptocurrency. So I think you should invest in the cryptocurrency, but only a few percentage of your disposable income. Disposable income, I'm sure you must be knowing. That is the income that you can that you can use after your expenses and savings. Now let's talk about the portfolio based on risk appetite. So the risk here is subjective. Portfolio means the combination of shares, or you can simply say the diversification of your investments. For example, you have 100 rupees and the 10 rupees you have invested in FD, 30 rupees you have taken the sovereign gold bond, and 30 rupees you have taken the fixed income securities, and the remaining you have taken equity investments. That is your portfolio. You have taken a risk and return ratio into consideration before investing, and you can not eliminate, you can minimize the risk using this portfolio investments. And the risk here is subjective, and the returns are more than FD, you can say. And return can be very much higher if you are if you understand the concept of portfolio. Portfolio is a great concept, and mutual funds, basically you can simply say the mutual funds is the extension, or you can say extension of portfolio. All right, so I would be covering mutual funds, and the best investment will be in yourself, in your career. I would again reiterate that best investment can be your career only. And if you invest in your career wisely, then you will be having the highest reward possible and without any risk. All right, so let's get to next slide. These in the previous slide we have understood the risk and reward ratio. Now the other factors you should focus upon before starting your investment journey, or before basically having your purpose in mind. All right, so first factor that you should consider is the purpose of investment. So if your purpose of investment is after retirement, for example, you are 65 years old, all right, and you need to have a particular source of money. All right, so you won't be getting into the equity market, you will be getting into the FDs, or you can go into the fixed income securities of the government. All right, so while having a retirement plan, you can invest there only. You won't be risking your hard-earned money in that. All right, if your purpose of investment is buying a house, or you have education in future, I am sure you will be having children. So if you have to buy a house, or if you have to educate a children, or you want to basically make them go to abroad. All right, so if you have that purpose in mind, then you can go for mutual funds. Since there is an app called Kuvera, I personally use that, where you can simply put up your goal, and you will be given the opportunity. You will be given the basically options where you can start your investment journey as a mutual fund investor, and you will have the returns possibly all the returns, and you will be achieving your goals. All right, so you can take risk at that time and buying a house, because you will be having a house almost after 10 or 20 years, your own house. So that's the thing. You can start your investment journey from mutual funds for that sort. All right, the risk appetite means how much risk can you take. For example, if you are and the age of the investor, these two both goes hand in hand. For example, if you are young, and as I know you are young, so if you are young, then you the long-term ones will have the 10% rate of taxation. All right, so you'll have to take care of the taxation, and the taxation rules keep on changing. So you will have to figure that out once you start your investment journey, that what rules are applying at that time. Now let's talk about compounding and inflation. These two topics are going to be covered in this slide. So any one of you knows about inflation? I think you can answer that. Anyone? No one? Okay, so I suppose you don't know inflation, so I'll be going from the very basics. Inflation basically reduces the power of your money. Simply saying, inflation basically reduces the power of your money. For example, you must have heard your grandparents or your parents telling you that in their times they could have get a house for almost 1 lakh rupees, and now that house is in crores. So this is what inflation does to your money. All right, the demand for the money, so the demand for the product is higher than the supply. That leads to inflation. That is demandful inflation, and there are many types of inflation. We are not going into that. We are just taking an example with this Apple story that I have created. So if in September 21, 1 kg of Apple costs you rupees 100, and in September 22, during the inflation is for example 5% per annum. That is, in September 22, that same 1 kg of apple will cost you 105 rupees, and the third year it will cost you 110.25 rupees. And this is what inflation does to you. And if you don't invest your money, this is the first example, if you don't invest your money, then your 100 rupees will stay 100 rupees after second year and stay 100 rupees in the third year. And in the second year you will be losing rupees 5, or you can simply say, in order to if you have the 100 rupees, you will be having the lesser amount of lesser than 1 kg of apples in those 100 rupees. So this is what inflation does to you if you don't invest. If you invest in a FD, for example, but the rate of interest is 4% per annum, that is lesser than inflation rate. All right, if the rate is lesser than inflation rate, again you will be losing out the money. And that is why I said FD is the worst thing that can happen to the Indian society. The reason is that because you will be still losing your money by, this is just an example. So if you invest in FD and the inflation rate is higher than the percentage gain that you are having, percentage interest that you will be having in any investment security, so you will be losing money. And we will be taking that in this case. I'll be taking after this slide. So next would be the portfolio or mutual funds or stocks. So if you invest in that and you basically defy the inflation, in order to defy the inflation, you will have to invest in the securities which give you percentage rate of interest higher than inflation. That is, for example, if you have invested 100 rupees, if at the rate 8% per annum, you will be having the 108 rupees, and you can still afford those apples, 1 kg of apples at 105 rupees, and you will be gaining rupees 3 INR if you invest right. All right. So let me take a step further by giving you the example of compounding. So this case is no increase in investment. Is if you start investing after your job or anything, if you start investing and you constantly invest 17,500 rupees per annum, or you can simply take 1,20,000, that is 10,000 rupees per annum, that is for 20 years, for example, and the rate of interest is 10% per annum, then you will be having the redemption amount, that is after 20 years you will be gaining 75 lakh rupees. You will be having 75 lakh rupees, and your invested amount is 24 lakh rupees. That is, the interest component alone is more than the invested amount. So this is the power of compounding. But if you simply reduce the term by 10 years, then you can simply say the interest component is less than the invested amount. So this is what the time horizon thing that I told you about takes place. And now the concept of inflation comes in. All right, for example, you have invested in FD at the rate 4% per annum. All right, so you will be having the amount of redemption amount of 14,98,000, that is 15 lakh rupees, and you have invested 12 lakh. You will be gaining 3 lakhs of interest income. But this is not the case, since the inflation is 5% per annum. As you can see here, we can simply assume that the 5% remains consistent in the upcoming years. If you invest in the FD at the rate 4% per annum and the inflation is 5% per annum, then you will be simply losing out your money. That the redemption amount will be 11.35 lakh and your invested amount is 12 lakh. How is that sounds? How does that sound? I suppose you won't be giving any response. At least tell me that you can listen to me. Can you? Can anyone confirm? Aryan? Arvind? Aryan?
Understood, sir, whatever you told us right now.
Thanks for confirming whoever it was. So I was simply saying that the inflation what inflation can do to your amount of investments. So you have to make sure that the investment amount, the interest on the investments that you are making is more than 5%, that is more than the inflation rate. All right, so you can simply have the amount of 15.84 lakhs if you invest in the 10% per annum security, and the nominal amount will be this 21 lakhs rupees you will be gaining, but the real amount means the actual amount that you can afford, the present value of the amount that you can be having, it will be 15.84 lakhs. All right, now let's talk about the case 2 where you can increase your investment year by year. For example, if you can increase your investments by 10% per annum and you are investing 10,000 rupees per month from the very beginning, and the rate of interest is 10%, then you can simply say the redemption amount, that is after 20 years you will be having 1.61 crore rupees, and the interest component will be more than your invested amount. All right, I hope I made myself clear with the with this compounding and inflation part. Now let's head to next slide. The mutual funds that I told you about, I'll be using the pen here. So the mutual funds are basically managed by a fund manager. As you can see here, it is managed by a fund manager. I didn't write, I guess. All right, and basically fund manager invests in various securities. There are various securities. All right, and they make a pool of it and distribute it to the users. Users means investors, that is us, at a nominal rate, that is small amounts. For example, fund manager has invested in Reliance, Tata, and Adani, and other small companies, that is any company, that is you can say Swiggy, or you can say Zomato, that is covered here, and they have the total investments of 1 crore rupees. All right, 1 crore rupees corpus is there, and the users and they distribute it for and they distribute number of units, that can be 10 lakhs, for example. 1 crore divided by 10 lakh would be rupees 10 per unit. So you can start your investment journey by simply taking 1 unit, that is at 10 rupees per unit, and you will be having the investment in all these securities. How does that sound to you? This is the power of mutual funds. And basically there are 3 types of mutual funds. Bonus mutual funds, where you will be having the having bonus units every month or every year as they announce. Second is dividend mutual funds, where you will be getting the money, particular amount of money from these funds every year. And the third is the most famous one, that is growth mutual funds, where your NAV means the amount in which you are investing. Investing, that is rupees 10 per unit, is your NAV. All right, this NAV keeps on increasing as and when the market fluctuates. All right, It is professionally managed by a fund manager, and we don't need a demat account. A demat account is basically your electronic account with the SEBI or with the NSE and BSE. It's basically free of demat account, and you can start your investment journey through simply ICICI app or any other banking apps as well. So many banks have been taking this forward as an investment journey, as making it easier for the investors to start their investment journey. You will have to take care of two things. First being management fees, and second being exit load. Management fees is the fees that is charged by the fund manager, which is this one. And the management, you will have to simply compare every mutual fund before investing, that how much management fees is going to be there for every investment. For every mutual fund, there are many types of mutual funds. The famous ones are Axis Blue Chip and ICICI Securities, and index funds are there. In index funds, the management fees is quite less. I will tell you the reason why. Because index funds basically the fund manager need not do any particular work. They will have to just go as the market flows. For example, if the Sensex, in the Sensex there is a particular percentage of, I guess that would be a little bit overloading for you. I won't be covering the index funds. Okay. Now talking about the exit load. The exit load is basically when you redeem the amount. When you basically redeem the amount, you will have to pay the certain percentage of your money to the management, to the mutual fund. Sorry, something happened. Yeah. So I was on the exit load. Give me a second, guys. So yeah, I was on exit loads, and it simply says that on redemption, a certain percentage of money you will have to pay as per the mutual funds. So that you have to see before starting your investment journey. Now talking about SIPs, it is a way to invest in mutual funds, and SIP basically means that a systematic plan, or you can say every month at a particular period of at a particular date, you will have to pay a certain amount of money that you choose for yourself and invest there with a discipline. And this leads to a great corpus which can have the benefit of compounding that I've already shown you in the Excel file. And you can easily defy the market fluctuation, and I will tell you how you can do that. Simply saying, the SIPs and the mutual funds are based on the markets. All right. So if you are investing every month rupees 10,000, all right, and in April the market was up, in March, in May the market was down, June, July, and so on, the market was up and down, and it was like that. And at the end of the day, you will simply be able to average out your investments. And that is how you can defy the market fluctuation using the systematic investment plan. All right, I hope you understood. Now let's talk about what you can do, what you need to do, or what you should do to start your investment journey. I've already told you application named Money Bhai, where you can simply start your investment journey, not your investment journey, your learning journey using the virtual money. But if you have money and you are basically, if you are teaching or if you are doing freelance work or internships and you are having money, then you can simply start your money from the amount as low as ₹100. All right, you need to have few things ready. First, Aadhaar card, I am sure you must be having. The PAN card you should also have. That is basically a card that is for the purpose of taxes, income tax and all. So that you can have. And the Demat account is necessary if you want to invest in equity shares, not mutual funds, just equity shares I'm talking about. So you need to have the Demat account for that. And the best app, you can say, simpler app, not best app, simpler app, you can say, is Zerodha, and the Grow app that is recently recognized. And the next thing you should know is about the fundamental knowledge about companies. Fundamental knowledge, basically, you can simply say, that is, you should know where you are investing. For example, you are investing in Reliance and you don't know anything about Reliance, then but that company is a great company, so you might not lose the money. But if you're investing in a small company where you don't understand the basics of the company, where you don't understand the industry that's working in which the company is working in, and you just simply invest in the FOMO, or you simply invest on the basis of tips that you are getting on Telegram and all. So if you do that, you are sure you can surely going to lose the money, and you may gain in the short term, but in the long term that won't suffice your investment journey. All right, you should understand the investment, understand the industry, you should understand the financial ratios, or you can simply say I'm going to give you an example. For example, if a company is there, all right, and there are two incomes being shown. The company is a car manufacturer, all right, and you see the profit and loss account of that company, and you see two income sources. First, on the sale of car. Second, on sale of crypto, for example. I hope you understand where I'm going. This is for Tesla. All right. So on the sale of cars, the amount of income they were having is 10,000, for example, and on the crypto, using crypto, they earned 1 lakh rupees. So what do you say? This company is a good or a bad company? No answers, I'm sure. So it simply depicts that the company is not focusing on on their major adventure, or on their major venture, basically for the purpose they started their business. So they are not investing in that, they are basically investing in crypto and earning from that. That shows a negative, that gives a negative impact of the company, and you should not invest in those companies where the earnings are from the other sources rather than the operating sources. All right, and you simply can see the past performance of the company. Past performance can simply indicate EPS. EPS means earning per share. Higher the earning per share, more the perspective of the company. Growth prospects, you can simply see the charts given in ET Money or many applications. You can follow the news for these growth prospects, how many projects they are going to have in future, and what is the impact, what can be the impact of that of that project in their earnings per share, or the dividend per share, or the market price per share. So you should focus on that, and that's how you can start your learning and ultimately the earning part. Now let's talk about the concept of FIRE. So FIRE means, I already told you in the beginning, FIRE means financial independence, retire early. So this is a concept which was recognized or majorly famous in US, and right now it's it's in the upcoming stage, in the starting stage of in India. So you should know what this concept means and how you can make use of it in order to retire early. I'm sure you must be having doubts right now that you have not started your journey yet, but you are talking about retirement already. But it's okay, you should know the concepts, and let's start with this. So there are few assumptions that this concept of FIRE has. First assumption being the expenditure that you are going to incur are going to be same. Same means if you are if your monthly expenditure is 40,000 rupees per month and yearly expenditure being 4,80,000 rupees per month, so you are going to spend this much amount of money only, but the inflation will increase the expenditure. So we will take the concept of inflation in mind. That is, in year 2 you will be needing 5,08,800 rupees, and in year 3 you will have to have 5,39,328 rupees in order to have the similar lifestyle. All right, so lifestyle remains same. That's the biggest disadvantage of this, and we don't focus on taxes in this. All right, so this is another disadvantage, but I will show you how you can simply mitigate that factor. All right, and the second thing, inflation, we have assumed that it is going to be constant. Sorry. So yeah, for example, you want to retire in 20 years and you must be 18 to 21 years right now, 18 to 21, 22. So if you want to retire in 20 years, that is, you will be aging 38 to 42. All right, and after retirement, how much funds you will be needing? That is, as soon as you want to retire, how much funds you need to have. This is the calculation that they are going to give. This is how they are calculating. So after 20 years, the expenditure that you will be incurring, that is, after 20 years you will be needing 15,39,425 rupees per annum, which will be similar to this 4,80,000 because of this inflation. First point. All right, and you will be needing this much amount of money after 20 years if you want to retire at that age. And how this is calculated? This the amount 4 crore 35 lakh rupees is calculated basis 15,39,000 rupees multiply by 30. In the US scenario it was 25, but in Indian scenario, after taking case of taxes, and we have assumed that inflation is going to be constant, so we have gone to the higher side and taken the multiple as 30. So you will be needing 4 crore 35 lakhs 68,000 rupees if you want to retire at the age of 38 or 42, whatever your age is right now, in 20 years you can say. All right, if you have this much amount of money and you want to retire, then you will have to focus on one and only thing, that you need to have the investment in fixed rate instrument, because you cannot have take the risk of basically investing in equity shares or markets where you can lose your money. But you can have you need to have the interest rate more than the inflation, that you will have to focus upon. All right, for example, you have the interest rate of 8% per annum and the inflation is 6% per annum. So as you can simply say, on the 21st year you have the corpus of 4.35 crores. I'll be telling you how you can have this much corpus in the next slide. 4.35 crore rupees if you have, then you simply take out the money, that is 15.39 lakh rupees, and the 4.2 crore rupees will be invested at the rate of 8% per annum, and you will be having the 4.53 crore rupees in the next year. All right, and you will be taking out this much amount of money, that after taking into consideration the inflation, the expenditure is going to be there, and this much amount. And at the end of the 50 years, for example, if you live till 78, sorry for that, you still will be having 7.94 crore rupees at the end of the investment journey if you don't do anything after your retirement. All right, that is after you are 40 and you don't do anything other than sitting idle. So you still will have 7.93 crore rupees in your bank account, and this is how the FIRE concept takes into place. But the only disadvantage here is that you will be having expenditure. You will be having same lifestyle, you can say. That is, when you were expending 4,80,000 rupees, and you still are basically expending 4,80,000 rupees only. This is just the inflation that is showing the higher amount, but you are still having that lifestyle only. So you can simply change the amount if you are into a higher lifestyle, so you invest in, you need 2 lakh rupees per month, for example, and then you will be needing 21.74 crore rupees. This is how this works, and this is just a calculation, and you can have this Excel file after, if you want, you can have the Excel file from me after this presentation gets over. All right, I hope you understood. Now let's talk about how you can generate this income. I've already told you, you should start investing in your career, or you can start freelancing, or you can start, freelancing is a great thing that can ever happen to Indian society. All right, so freelancing, Indian society, because US based companies give work to freelancers in India, and this is how you can make lots and lots of money, and you can simply, and you can have this thing possible, all right, after 20 years of your work. So that you can do. I hope it's understood. I need to talk to you about the gratuity here. I haven't taken this into the slides. Gratuity basically is given to the job people, and it is given after 5 years of work, at least 5 years of work. So this gratuity is also a great investment opportunity. And if you have worked for 20 years and the basic salary that you are having is 1 lakh, not 1 lakh, you will be having a great deal of money if you are working in a same company for 20 years. So you have, for example, 3 lakh rupees per annum at that time. So after 20 years of your employment, 3 lakhs multiplied by 20 into 15 by 26. This is the formula that is for the gratuity. You will be given 34.61 lakh rupees from that gratuity alone. If you don't invest anything and you stick to a particular job for a long term of time, you can have this much of gratuity. So this is the great investment opportunity that only job people can have. All right, and another thing is EPF. EPF is basically the particular percentage of money that is deducted from your bank, from your from the salaried employees, and the basic. And if you are into business, then you can invest in PPF, that I've already covered. EPF is only for the salaried. EPF and gratuity is only for the salaried employees. All right. So EPF is basically 12% of your basic income of every year, and you can simply assume that the similar amount of money is going to be there after 20 years of work in a particular company, or any company, you can say. For EPF gratuity, you will have to stick to companies for at least 5 years. So you can have the 69 lakh rupees, for example, if your last earned salary is 3 lakh rupees per month, I'm saying. All right, so this much amount of money that you can have to start your investment journey, and the other, you will have to focus on your investments and your expenses. All right, so I hope it's clear. Now a few miscellaneous questions that I have covered. First being credit card versus debit card. Let's cover it only today. So yeah, so credit card is highly rewarding, but psychologically speaking, it leads to overspending of the money, since you can use it for the cashbacks and all. So you will have the high rewards, but you will end up spending more than the rewards that you will be getting. But the advantage is high rewards, you can say, and it helps in improving the credit score. The credit score, if the credit score is higher, then you will be getting the loans if you get into any emergency, or God forbid anything that you don't want to happen. That credit score can help you get the loan at a lower rate of interest. So credit card helps you generate that credit score. International tax transactions can happen only via credit card. And the bandwidth for payment of debts. Bandwidth means that, for example, if you have incurred expenditure of 15,000 rupees for this month, you'll have to pay on the next month when the bill is generated and on a particular date that is given. But if the payment is late because of any reason, you will have to incur heavy interest and penalties. So that's the disadvantage of this, and may lead to overspending. That is again another disadvantage. And psychologically, debit card spending remains less in comparison to the debit cards. 2 credit cards, and the investment and penalties are skipped in this manner in this debit card scenario, but it's less rewarding and it cannot be used for international transactions. So that's all for credit card versus debit card. And few tax compliances that you should be understood, that you should be having knowledge of. For that is, as an individual, you will have to file an ITR only and only when your income is 2,50,000 rupees, more than 2,50,000 rupees in 2,50,000 rupees per annum. All right. So if your income is more than 2,50,000 rupees, then only you need to file the income tax return, generally speaking. All right. And you will have to file the return by 31st of July of the assessment year. In this month, this is because of some issues, it's 30th of September, but in general scenario, it's 31st of July of the next year. All right. And the sources of income you have to see is first salary income, second business income, third capital gain. Salary income you can simply understand. Business income or professional income, if you are into business, then you can have that income and you will have to file a different return than a simple returns. If you have the salary income and other income, that is interest and all, you need to file the returns in a simpler manner. But if you have a business income, then you might need a CA for that. And if you have a capital gain, then again the particular percentage you will have to focus on. That is, I have already told you that if you earn, if you have invested 100 rupees and you have gained and you have redeemed the amount for 150, then the 50 rupees is your capital gain. So that's the thing, and you need to file a different return for that. So there are different types of returns for different incomes that you are having. That's my scenario. That's the thing I'm talking about. And what are the benefits of filing income tax return? First, it is mandatory if you have income of more than 2,50,000 rupees, so you can simply mitigate the penalty factor. All right. And second is record maintenance. Your records will be maintained. And the third is personal financing. If you have the records of your income, then you can simply you can easily get the housing loans or any other business loans that you might need in future. All right. So that's that. Now let's talk about Money Heist season 1 and 2 in Indian scenario. So I would simply say Modi ji can simply demonetize if that thing happens. So the season 1 and season 2 will be doomed. But let's take a step forward, that if we print unlimited money to mitigate the poverty factor from Indian society, then that can simply lead to hyperinflation. The inflation that I talked about was 5 to 6%. Hyperinflation was simply more than 50%. But in Zimbabwe in 2008, there was a time that even 100 trillion Zimbabwe dollar was equals to $1. That is 70 rupees INR. That is right now 70 rupees in India is equal to 100 trillion Zimbabwe dollar. In 2008, that happened. This is the worst case scenario that can happen if you print unlimited money. And the concept of fiat money takes into place for this types of investment. That's I think that can be overloaded for you. We'll simply skip that. And the currency inflation is basically on the reason. The reason of currency inflation is because increase in supply of money that makes people believe that there is no value in the money, that everyone has 10,000 rupees, sorry, 10,000, what I'm saying, sorry. For example, this picture, as you can see, this child in Zimbabwe had this much lot of money. So in the eyes of people, the fiat money, and they will eventually lose the respect for the money, and this will lead to over prices. That is, supply is limited, supply of goods is limited, supply of money is unlimited, and the demand for the goods is unlimited because you all have the money, and the prices will inflate eventually. And this was the $100 trillion note that was printed at that time. So that's that from my side. I hope you understood everything, and if you have any questions, then do let me know. Any takers? Anyone?
No, sir.
Okay, so that's all from my side. If you don't have any question, you can simply contact me with this on this number if you have any questions, and you can simply take it. You can simply put it on the WhatsApp on your group as well, and you can follow my YouTube and all LinkedIn, so you can have this slide. So that's all from my side. Thank you so much for having me here, and wish you luck. And I really hope you will be succeeding in your career and you will be financially independent and you will retire early. All right, that's all from my side.
Thank you, sir, for enlightening us about financial education and giving such great advice. Also, I would like to thank all the participants for maintaining the decorum throughout the session. Hope you gained a lot of knowledge about financial independence. We will be providing a feedback form on the WhatsApp group and the chat box. Everyone is requested to fill that form and you will receive your certificate after filling it. Thank you.